sustainability and obtaining, and following the federal rules. And certainly indirect rates is certainly a part of all of that. The last 17 years of my career, I have been with Rubino and Company, used to be Rubino and McGeehan. And basically what I do is in the consulting realm. And so just to give you a background, we have done a lot with the HHS, Division of Cost Allocation. And we're quite familiar with them and some of their different regions around the nation. And so we have developed several rates for clients and entities that needed help in putting their rates into HHS and other agencies as well, but certainly HHS because most of the money goes to them, to federal awardees, compared to most other agencies. So we have quite a bit of experience in that. Last week's topic really went through, the rules and the basis for developing an indirect rate. And we also talked about the super circular and the impact of the super circular on developing indirect rates. And so just a very brief, because this session won't be as long as last session, just a very brief overview of last week's presentation. The new super circular gives you some options that you didn't have before. And you're permitted to have a 10%, what they call de minimis, indirect rate with no backup at all that you can use once these new rules go into effect, which would for you would be the first funding mod or new grant award after 12/26/2014, on or after. So some of you may get your funding and re-ups around October 1st, and I don't know if they would put language in there, so you may still have to wait. And the rules basically are if you're if you don't have a new funded mod after obviously 12/26, you have to follow the old terms and conditions. I also am familiar with the Hhs program. I am familiar with the fiscal monitoring standards and all your different parts that go along with it, and I know there are lots of restrictions. And so entities today are looking at sustainability, looking at indirect rates as a possibility. A few basic things from last time, just as a summary level, and then we'll get into today's discussion, which won't be as long, is that not only are you allowed to have a new 10% de minimis rate, but also if you have an existing, some people call it a NICRA, a negotiated indirect cost rate agreement, and you have one, under the new rules, you can ask the agency for 4 years extension of your rate without change, but you're stuck with that rate for 4 years, and then afterwards you would submit it. So the whole deal with negotiating indirect rates is really once you start doing it, the government expects you to do it every year, year after year, and you got 6 months after your year end to get it in. They give you time because obviously they want it based on your audited numbers as well. So last week we focused really on, if you did not know, the new regulation, which is 2 CFR 200, and the cost principles start at 200.400 or subpart E as an elephant. They also have appendices because they realize state and local and tribal units of government have different cost allocation plans that are quite sophisticated, and so do institutes of higher education and what they call, and what we're going to continue to call, an F&A, facility and administration indirect rate. And then Appendix 4 to the new rules is where you get into the nonprofits and the hospitals. The cost principles, or the rules for hospitals, there are special rules for them. That's the only part of the new super circular that has not changed. That's under 45 CFR 74, and I think it's like Appendix or Attachment E. That has the only thing that has not changed if you're a hospital or operate under those rules. So I thought I'd bring that to your attention as well. Some other things to consider from the last time, because this gets into how we build our indirect rates, is just remember the importance of identifying unallowable expenses. Remember also that there are certain items that go into the allocation base, the denominator, and they stay in the denominator, even if they're not recoverable, such as fundraising, membership, if you might be a membership group, public relations, and lobbying, any form of advocacy policy, that kind of thing. So just remember that those major areas the government considers non-recoverable and must be a direct functional area. So regardless of how your statement of functional expense might be set up, you have to, of course, adjust this a little bit to an OMB basis. So that's something else you should remember. And also under the new rules, if they do determine that your indirect rate had a portion of unallowable costs, there'll be a methodology that unfortunately you're going to have to pay it back if it's historical, or adjust if it's going forward into future periods. And the government's very, very, very concerned about double charging. You know, costs that are for like purposes, if you've got direct purpose rent, it stays direct. If you've got indirect rent that supports the admin people, then that may be indirect because it's of a different purpose. A couple other things that we touched on last time which are important is we touched on the importance of proration of direct costs. So if you have direct costs that could be prorated, like a workshop, and you based it on the number of individuals served or attended, you could just naturally allocate it on that basis if it's not too difficult. Otherwise, you'll have to come up with some other approach. And the other thing that we learned last week was that administrative personnel, especially if you're a smaller entity and you've got people that wear many different hats, and you've got an ED or a VP or a program person that's a department head, they can also work directly on a program or a federal award. And also the finance people, because there's budgets, there are financial reports like the FFRs, lots of reporting, as you know, financial reporting through the Ryan White program. So if you want to allocate a person direct and that program permits you to allocate it direct and it's approved in your budget, and as long as there's a method for tracking their costs, such as timesheets or time reports, and that part that is now charged direct is obviously no longer in the indirect, then the government will approve that. People have been doing that anyways, and many agencies have approved it, but now they're going to officiate it in the new rules. So today is really a focus on a more practical, you heard the theoretical, the conceptual, and the regulatory requirements. Now we try to get into, how do you build this thing? If you were a consultant to a firm or you're the new director of finance and you needed to approach an indirect rate, how would you do it? And of course, the way you do it's got to be the way the government agency, since most of you have Ryan White or HHS money, we will use the model that HHS has from the Division of Cost Allocation. I think they have 4 or 5 regions in the United States. So we're going to talk about the approach in developing an indirect rate. We're going to look at something called a cost accounting matrix, where we look at expense accounts and all the expense accounts as they might relate to different functional areas of programs, like a matrix, columns and rows. We'll talk about the HHS template for developing it, and then we'll start looking at what documents really entities deal with. Post-audit trial balance, which obviously means that there were audited financial statements. We'll reconcile to those statements, particularly the statement of functional expense. The statement of functional expense that may be for a GAAP basis or 990 basis, we can change a little bit of that if it's appropriate to an OMB basis so that you get full cost recovery. And then we'll obviously get down to calculating the rate and looking at an actual negotiated indirect rate document. Fortunate that we had one of our clients that volunteered in letting us use their stuff, so we've redacted some information so that you can really see what it really looks like in putting one of these packages together. And even though their revenue and their expenses were maybe relatively small compared to your organization, that really is good because it helps us to dive into the details. And everything, as you know, is always in the details. So again, we're going to provide the hands-on skills and tools to develop this. We'll see what the real documents look like in putting together an indirect rate. If you're going to start to develop an indirect rate, the first thing you really want to focus on is, well, where are the documents? How am I going to look at this? How do I approach it? And because I've done a number of these, it's not hard for me to do. So I can give you some of my secrets in putting it together. The first, most conceptual, and most of you know this anyways, if you develop an indirect rate, it's for a fiscal year, and the government wants it for a fiscal year that's completed. So that's last year's fiscal year, what we call trial balance, and if it's been audited, post-audit trial balance, where you put all the entries, if any audit entries affect the expenses or revenues or whatever, that's been incorporated into it. And the other thing is that when we develop indirect rates, those rates are for the organization as a whole. A lot of people want to just do it for their federal awards. Government won't let you do that. They pretty much want you to have an indirect rate like a fringe benefit rate and a simple G&A rate, general and administrative rate, for the entire entity. And if you try to do it any other way, you won't succeed. We'll look at the chart of accounts. We'll look at the last year's audited statements, and particularly the statement of functional expense. Yes, your annual budget can be a part of this process too, and I'll talk about that a little bit. You definitely want to look at your grant documents, since you're Ryan White folks here. You know there can be program restrictions like the 10% administration cost in a grant year. So you got to look at that too. And then we could even look and say, you know, if I came to this organization, did they ever years ago have a previously negotiated rate? If you're new to your organization, you're in the finance, find out if they had it. They may have had it and they gave up on it for one reason or another. Look for it, because it can give you a lot of insight into what you need to do today. So, the summary of the control accounts is what we often call a trial balance. And really the most important is last year's, because it's a full year. So the question is how close are you to your audit? If your audit's been done, you know, even though many organizations, they do of course the financial statement audit first, and then they do this A133 audit. Once you've got draft financials, probably you're ready, if you want to start working on your indirect rate, because you know that you got to 9 months after year end to finish your A133, and you certainly don't want to wait that long if you're starting to develop an indirect rate. So you may want to get that information as quick as possible. It's very hard. The government, in rare instances, might let you prepare, let's say, a rate that's partially filled with actual costs on a year-to-date basis, let's say like 9 months or 6 months, and then you have a forecast for the rest of the year. Something like that would be called a predetermined rate. It's the only opportunity. And if you've never had a rate before and you want to do it on an estimate, you can. But last year's costs, unless you've made major changes to your structure, is probably good. But again, if you had a major reorg or something like that, that's something you're going to have to consider. We're going to go forward as if you used the last year's fiscal year rate, because often the last year fiscal year rate that's negotiated with the government, let's say your year ended 12/31/2013. By now, we're in May, audits are probably being done and finished. So if you got FY 12/31/13, and definitely if you had 6/30/13, you would want to use your most recently completed and audited fiscal year. Now, you know, as you get closer to June, and if your auditors came in right away in August, you may want to wait simply because you got more updated information. On the other hand, at this point, you might want to say, if you had a 6/30/13 audit, I want to get started now, because once I start that audit time, everything is devoted to it. And I've done my 990 and it's all done. And I didn't have to worry about the May 15th, which is today deadline, the last deadline. So we're going to base this on historical data. So sometimes the prior account structure, if you're a smaller entity and you really haven't structured things or thought through those things, and they kind of get accounts that kind of grow here, they grow there, they kind of grow like weeds that you can't seem to manage or control, this may be a time to look at your account structure. For larger, very well-developed organizations, you can't operate unless your chart of accounts and your functional areas and your programs are properly set up. But if you did have to remanage your chart of accounts, you'd certainly want to simplify it. The last thing you want to do is make it so difficult and so unwieldy that it's hard for anybody to understand. And actually, by simplifying, reduce the work for the accounting staff What I'm calling a matrix is that the rows are the general ledger accounts, the departments, cost centers, or programs are the columns which ultimately become the functional areas in a statement of functional expense. Standardize for consistency. So if you have, let's say, a labor account that's $5,000, then it could be used for all the departments, whether the department's direct or indirect. The department or the program is going to signify, is this a direct cost or an indirect labor cost? It's just an approach. It doesn't mean you have to do this. And this new chart of account becomes the basis of your new cost accounting system, because the way it's set up will make it much easier for you to generate indirect rates. See, a lot of times the large organizations, they may have not developed an indirect rate. Now they're thinking maybe this is something to go after, because they don't just have Ryan White and the Ryan White limitation of 10%. Even if they have an 8 or 9% rate or a 15% rate, they may have other HHS programs that don't have such restrictions. And you should be aware of it. Many HHS programs don't. If you want to see all the HHS programs, a good way to look at it is to go to C as in Charlie, F as in Frank, D as in David, and A as in Apple, cfda.gov, the Catalog of Federal Domestic Assistance.gov. It will tell you where the funding is for the programs and the program restrictions, and if there are any restrictions on administrative cost or indirect cost. Most of them don't have those restrictions. There are a few like Ryan White, but there are others that don't, that aren't the payer of last resort. They just, as you go, you're funded. Another thing you should consider is, because your annual budget, maybe you should begin to start looking at that like the statement of functional expense, which I'll show you later. And whenever you develop reports and you've got lots of data, try to fit the most meaningful information on one page. The summary page has the summary of everything, and then each department has its own detail. And try to keep the counts at a summary level, even if you can drill down to greater detail, so that every report fits on one page. When you start looking at different pages, either across the way or down, and you're going to see this in my presentation, even how I will be struggling looking at this real client's statement of function expense that's on like a 8.5 by 14, not a legal page. It does get unwieldy, and it is hard to look at. This is just food for thought as you start to restructure. The schedule of functional or statement of functional expense is a critical document, not only that you see in your current 990s, not only do you see it as many of you may be preparing it, especially if you're a health and welfare organization. If you aren't, the government's going to ask you to prepare it even if as a supplemental schedule that's at least reviewed by your audit firm, so that all the numbers reconcile. And let's look at one. I think the next one, yeah, here we go. This is from a textbook. So, Helping Hands Children's Organization's Statement of Functional Expense. And because I remember last week. So, up here, what do we see? That's where the labor, the executive salaries, and benefits are. The lower level, that's where the non-labor is, to get to total expenses down here. Program A, Program B, and so forth, they're all direct programs or functions. Under A122, or the new super circular, fundraising, it goes over here. Even though you may do it that way for your statement of functional expense, when you start to develop because you probably put together an Excel file for them, you're going to move fundraising over after Program C, and then total program costs will be direct costs, total direct costs, where all that is left is management in general. Now, if you're super large, you may break it down into facility and administrative costs, but effectively, for simplicity, management in general is your indirect. So it'll be your indirect here, and that will be divided by the program cost there. Okay? And that's how that's going to work. If I put any more things on these X's and O's, it's going to look like a football diagram. But I think you get the meaning of it. There's something else that's very powerful about a statement of functional expense. Let me get a different color up here. Give me a second. I like blue. What would be really smart is look at total expenses down here. You can put the effect of your G&A expenses in this column. You can take that and apply it. I don't know, say it's a 10% rate. You can apply that and have a line down here under total expenses, which is your indirect line. Then you'll total it under program ABC and fundraising. And what you'll ultimately come up with is total expenses, I'll put a T for it instead of the I. So you got an I and a T. Indirect is there, and then total is at the very bottom. What's helpful with total expenses that include indirects is you can then turn this into revenue. I'll just put an R up here. And you could find the revenue for all these areas up to the total direct. Compare the revenue with total expenses, and you'll find out your pluses and minuses, your loss or your negative net assets by program. So this statement of functional expense is a pretty powerful document. It'll tell you where your money's going and maybe where unrestricted funds are going that you don't want going out the door, but at least you know where they're at. And then you as an organization can make decisions about it. So the statement of functional expense is extremely powerful. And that's why I recommend, as a thought, that one of the formats of your annual budget should be in a statement of functional expense process. Because the budget's used for this year's projected indirect cost rate, that's a possibility. But it also can be modified as the year goes on, and you impact what I said, the management in general, or G&A, to the bottom line, and figure out revenue versus total expenses, where total expenses includes your G&A expenses, and then you know how each program is performing. And you've got to know that. Tax-exempt organizations permit you to have some loss leaders, but it's going to come ultimately out of your reserve, or you're going to be borrowing, which would be horrible. Somehow you got to pay for it, or it comes out of unrestricted revenue. And we want to limit that as much as possible as good managers to our stakeholders. Another thing to begin to ask the question, you're the new CFO or Director of Finance on the block. Hey, did we ever have a negotiated indirect rate before? And you say, yeah, we did. Well, let me please see that document. We'll show you an actual one at the very end with HHS. And they're similar agency by agency. Because that's going to tell you how the rate was computed, the allocation base, which is very important. Did you use a total base and modified total direct cost? Or did you use a smaller base of salary and applied fringe or just direct labor base? What your cognizant agency was in their context, were there any special limitations? This actually goes through the whole process on a negotiated indirect cost rate agreement or NICRA. Applicable historical fiscal years. What was the new provisional rate? Of course, it'll be long ago, and so it may be a little bit out of date, but it gives you insight into the way the organization thought about presenting their rate years ago, what agencies they dealt with. So maybe it's an approach to start thinking about, maybe I'll pick up from that. Something to think about. People don't realize, but sometimes those resources that you need so much are maybe right there in your historical file and you didn't even know it. The cost accounting matrix is my terminology, so it's a Paul word that I made up. But it actually goes back, and probably the best way to show you is to the statement of functional expense, where basically each row is an expense, okay? And each column making up this document is a matrix, is either a program at that level, it could be a functional area, it could be programs, departments that become a functional area that give you total program, total management in general, and ultimately fundraising, which is the way they want you to present this. So that's what I mean by a matrix. And this probably is the best example, document-wise. It's the framework for your cost accounting system and your indirect computations. And the more straightforward, the more simplistic you make it, the more well-organized and thought through. You don't have to build a rocket ship to the moon now. You don't have to make it so sophisticated. You make it as sophisticated as you need to for special allocations, internal, and so forth. But don't do it just for the sake of doing it. You know, you're like a 5 million entity in expense or revenue per year, and you know you've got this 50-page document on cost allocation plan. That doesn't make sense. It might for the state government of California, but I don't know about just your little organization. Yeah, there they would probably have a very sophisticated cost allocation plan that they need to have. But for a smaller itsy-bitsy agency, it should be more simplistic and straightforward. Keep it simple. It is very important to do that, in my humble opinion. So the framework of a cost accounting system or matrix is going to make it easy for you to develop your rates. And the very basics, as I said last time, as this time, you should be able to separate, especially among federal awards and from federal and non-federal activities, separating the cost and funds, distinguishing that it's very clear what's direct. You would never make a cost objective or a program have both direct and indirect costs, or a cost center that could have both direct and indirect. I mean, unless it's going to be further allocated. You want things that are clearly identified, or it is a special, what we call service center, like occupancy, fringe, that might be further allocated both direct and indirect. In other words, you want to make these things very clear. And because we have to deal with the federal government, we have to add the extra step of identifying and segregating unallowable expenses. If they're direct, they remain in the denominator or the allocation base. If they're in the numerator, they just come out of the numerator. So those are things we have to be continually mindful of as we develop. Now here is somebody's, this is a very top level, 20,000 foot. These were their lineups: salaries, a fringe line. I'm going to come back to subawards in a minute. Supplies, communication, an occupancy line, equipment, maintenance, repair, travel, depreciation. They try to keep it pretty high level. Now, if you can, there's probably a few other items that should be there, but the point is, it's a high level thing that can fit on a report. Then you can drill down. Now, what they decided to do was they decided on the subawards to have two accounts. One account, as you know, if you have a modified or total direct cost base, the first 25,000 of an award, subaward, subcontract, contract, whatever you call it, over the life of such vehicle, the first 25,000 remains in the denominator. So you could have one account that shows it that way, and then when they get beyond that 25,000 over the life and into fiscal years, you have a separate subaward account that basically puts it in that. But when you do your indirect rate, you've already divided them up, and you've separated the awards for the current fiscal year that's under 25,000 that will be in the modified total direct cost base, and then you'll have another account and say, oops, I cannot include that because we know that they are above that 25,000. And it could even been from a prior year because it's over the life of that contract. Just as I'm going through, and we will have a Q&A at the very end, you're welcome to ask questions as I go along. I guess you would have to type them in. You probably see a Q&A box, and if my eye catches it, I will certainly look at it from time to time. Feel free to type in something. Just try to make it straightforward. Try to think of it that a lot of people are listening, and I've got to think about it, and yet, you know, you can't tell me your life story. But certainly try to make it brief, and I will try to respond to it while I'm talking, if you like. Thank you. Here's a simple natural account structure. Some of you may be smaller and have something like QuickBooks, which is commercial off-the-shelf software. If you did, you could make the 5,000 what they call cost of goods sold, but it's just direct costs. 6,000 could be your fringe line. 7,000 series of GL accounts could be reserved, or it could be overhead. If you want, not overhead. A better word would be occupancy. Should have updated that slide. So you may want to put your occupancy separate from your administration costs, or you can leave it reserved and not use it. And we'll assume that in this simple example, both occupancy and administrative is in the 8,000 G&A series, and 9,000 is unallowable. From this, I could develop an indirect rate probably in 15 minutes. I mean, this is not complicated. Then I have all the stuff. I have my indirect on this line. I know where my direct are in this. Now, As we said before, you don't have to make the GL series conform to direct and indirect. This is a more simplistic organization. As you get larger, that's where these matrices come in. But it is something simple. Also notice 9,000 is a nice little control. Say, Paul, we never have unallowable costs. Come on. Everybody has something unallowable. So think about it. I bet you do have some unallowable costs. Even if you don't, by putting the 9,000 account in, and I tell you, I've talked to organizations, and I was trying to help them because I was representing a prime and doing subrecipient monitoring, and they said, we insist that we will not ever put in a 9,000 series for unallowable costs or some other mechanism. And I just say, you know, when an A133 auditor comes in and does it, they can at least see, okay, there's nothing in there. It means you thought enough about it to segregate the cost. But I got a lot of stubborn people. Maybe they didn't like me. Maybe I wasn't nice to them. Maybe I should have been. But I think it's a good policy to have. It could be a 9,000 series expense account for unallowable. It could be one of those columns or matrix that you have. It could be done a lot of different ways. Something to think about. I'm just trying to help. Well, we're getting closer to the end of the text part, and we're going to get into some real examples here that hopefully will help you. But when you do develop your indirect rates, especially some of the larger organizations, and if you remember last week, for those of you who are here, I talked about program administration costs. That if you're starting to be an entity that gets, let's say, 50 million, 100 million, some of you wish you were that large, but there are people, there are hospitals, clinics that grow, and they're very, very large. You may have administration costs that are not general and administrative that benefit everybody as a whole. They benefit your functional area. So you may have like child care, foster care, and those two are separate, different areas. And they have their own administration groups, and they're fairly large. You may have a department head in each program area. Those costs are not G&A because they only benefit the programs under them. They can't be switched equally between one group, program group like foster care as an example versus child care. They couldn't be swapped between the two. However, general administrative costs, they do benefit the organization as a whole, and they would be like executive directors, executives, the finance director of finance, you know, HR, IT, facility management, and the like. They can be spread over all of them, not the program administrative costs, because they're not company-wide. So as you get larger, you have to be aware of that. Now, another thing that happens is to be conform with the GAAP or the 990, and we'll show you this later in an example. They may ask you to, or you may allocate a certain portion of your G&A. I've seen it on a certain line item. Going back to that statement of functional expense, there was a line item, let's say, for overhead allocation or allocation of indirect or something, but it isn't all of G&A. That can be reversed back, and we'll show it to you in an example, to get total G&A so that you can recover all of it. So if for some other means, a GAAP basis, 990 basis, some of the G&A, true G&A, occupancy or admin, was allocated down or out to the programs or functions, we can reverse that allocation so that because they're all generically G&A. And that's the goal. That's why sometimes a statement of function expense won't reconcile to your indirect cost rate proposal because there's what I call an OMB basis for a rate, and it differs than GAAP or 990. So be aware of it. You can have a GAAP basis rate, allocation which conforms with GAAP or 990. You can also do it where you pull the cost back into G&A for OMB to get the most cost recovery. Be aware that in organizations that have consolidations, they have many different entities and affiliates. And if the grant and the rate you're trying to do is in the Inc., you know, the original prime away from the affiliates, you know, you're going to have to do a separate reconciliation in your audited statements. There should be a consolidation and then show what each individual one is, and you may want to do that. So that would be a good thing. And also cross-company affiliates. If you do have affiliates, say you have a fringe benefit pool, it may reside in the Inc. big piece versus the affiliates, and you may allocate those costs from the main entity to these other sub-entities. And so part of that total allocation has got to go to a subsidiary, so the total allocation is going to be less for the Inc. where the grants are. Maybe hard to visualize, but that's something to think about. Now, someone had asked a really good question to talk about the difference between indirect costs and administrative costs. And pretty much there can be a difference because perhaps, and again, because I don't have the fiscal monitoring standards in front of me, you could have program administrative costs as defined by the program that are administrative costs to run the program. And that may be allowable as a direct charge even versus an indirect charge. But they may say whether it's direct or indirect, your total administrative costs are limited to 10%. When I talk about indirect, and unfortunately it's true, I do use this synonymously with administrative costs, and it can be confusing. For these indirect rates, let's at least define for our purposes, because certain programs like Ryan White can define it differently. These are all the administrative infrastructure costs, and when I say indirect, and therefore indirect would be the facility and everything maintaining the facility, the plant, the occupancy, rent, leased, owned, depreciated, fixed assets, that stuff. And then on the other side, the administration costs would be executive management, your leadership team, finance, HR, IT, facility management is in the facility piece. Those are the kinds of things. Line items would be, that's where your audits would be. That's where you would have some of your legal fees, your consultants, those kinds of things would be large line items in there. Insurance, business insurance, those kinds of things. Those would be the indirect. When we talk about indirect rates, not Ryan White program administrative costs, but indirect rates a la A122 or the new super circular, we're talking about a general and administrative total rate for the organization that includes a facility piece and the administrative, where the administrative or the indirect is basically the the admin piece apart from the facility would be HR, IT, purchasing, not facility management, executive and director of the finance group. So hopefully that kind of clarifies a little bit. That's a good question, and it means different things to different people. We went over that last week, so if you're still unclear about that, and it's though a very good question, go back to last week's, recording. It was recorded, and the PowerPoint, and I do address specifically what is administration versus facility costs. That's part of your G&A that we define as a part of the indirect, separate and distinct from program administration cost or administration cost as defined by Ryan White, which may very well be different. Okay? Hope that helps. That was a long explanation, but a good, excellent question. Also, other things you may want to keep in mind as you go through this process is that, say you have a large facility. These are tendency to be for larger groups that start to get, over 10 million, 20 million, 100 million. They always have some space in a building that can't be leased out, and often what they do, because they're very smart, is they rent it out. That's fine, but the rental income has to offset your occupancy cost. There is, again, in A122, currently in place, and the Super Circular, that credits, rebates, income, discounts are offset against the grouping. In this case, if you're taking a facility and the government's paying for that facility, you can't put, I'm going to sneak the income up on a different piece. GAAP may ask you to do it, but you need to offset your occupancy costs for an indirect cost rate proposal. And as I said before, HHS last week, HHS will not permit the recovery of special indirect rates such as recovering local overhead or program administration costs. And when I'm talking about program administration, I'm talking about a very large organization that has like child care versus foster care, and they have a subgrouping where these people are located. Either, if you're smart, either put them back into G&A and make them generic that way, or make some of those costs, if possible, in the grant direct. But outside of that, this intermediate program administration cost, and I'm talking about from an infrastructure, not Ryan White, the government will not recover that, let you recover that through a special rate. So that's something you should be aware of. All right. We're now going to start to take a dive into some of the actual documents of a real life entity, a smaller entity that had about 2.4 million in expenses. And so you can kind of start to get an idea what their issues were. We're first going to talk about currently, even though in the new super circular proposal, bid and proposal costs will be allowable, HHS does approve it as well. And I just want to show you the citations because that's important. And that form is not fundraising. Bid and proposal is not fundraising. It is allowable, recoverable costs, and we'll talk about that definition in a minute under the current rules. Some of the unique problems that Helping Hands non-for-profit had that many groups have is they never had a negotiated indirect rate. So sometimes, like with occupancy costs, they have it direct in certain times where grants will allow it direct, and in others they don't, and it becomes a problem. And we'll see how they kind of resolve that. We'll review the HHS Statement of Functional Expense format. We'll go over the audited schedule of functional expense, the post-award trial balance from a real organizations. Then we'll look at their indirect proposal text and their computation, and finally the negotiated indirect cost rate agreement, which we call NICRA. So that's what we're going to go over today. So now what I'm going to do is magically switch it from this to a PDF. Here we go, good. It's still in that form. I can't turn you off. I can't do that. So, in any event, if I need to move down this thing, hopefully, so what I want to do is go down the page a little bit with you. This first item up here, for lack of, this piece right here, this came from the terms and conditions of an award, a current award. And it's an HHS award. This happened to be, I think, through CDC. And they cited this regulation, 45 CFR 74, or 92. And so the Division of Cost Allocation was saying to this client of mine, you can't recover bid and proposal cost. And I would differ and disagree because I believe you can. Good. I think I finally found. I am not an expert with, well, 1 second. We're going to get this. Still can't slide down. In any event, down below, someone's here to help me. I just need to slide it down the page, and I can't get it off the marker. How did you do that?
Just on the side.
Next to the side. Mm-hmm. Okay. We'll try it, and I'll see if I can do it. Thank you. You can see I'm a PC person versus an Apple person, and that's where the problem is. Thanks to Julio. So this is the regulation. And it's in 45 CFR 74, and you're saying, oh, that's all gobbledygook. But this is the regulation for HHS. The only item they deal with as allowable cost, bid and proposal. So if you had the citation in your terms and conditions of your federal award, go back and look. You can recover bid and proposal. They're the immediate costs of preparing bids. And guess what? For both federal and non-federal awards, like private foundations, contracts, other agreements, and it includes development of any scientific cost or other data needed to make your proposal. So, bid and proposal, here's the most prolific statement. For the current accounting period, are allowable as indirect cost. So as you start to develop an indirect rate, you should know, especially under the HHS rules, that that as long as you have an indirect rate, you can put bid and proposal cost in the indirect cost rate or cost pool, the numerator, and it will be allowable. So don't confuse this with fundraising. Ultimately, you could say generically, yes, you're raising money, but fundraising is unallowable because it is for contributions. It's not an exchange transaction. You're raising money for the organization, and you don't know how successful you'll be or whatever. The government's not going to participate in that cost. But when you're putting together to respond as a request for an application, those costs are allowable, and you should be quite aware of that. Anyway. Here, and I like the color of this. This came out a little bit differently. Looks like a purplish blue kind of color. But this is the official statement of functional expense. And let's go down on this a little bit. One little bit more. Perfect. This is the formal statement of functional expense example. We looked at it a little bit last week. And this is very important. If you're going to submit an indirect rate to HHS, and this is true for all the agencies, they want to reconcile to your audited statement of functional expense. So they'll look at the financial statement numbers up here, and the grand total is $2.6 million at the bottom. That's what they're going to look at. The next column is adjustments. That's the adjustment column. So if something's unallowable, it doesn't fit in the base or the numerator, it gets fixed and resolved with explanations and notes below, down here. Okay? And then in this small and simple example, these two items here are programs. This is Community Service Program, and this is a Head Start. These are both HHS programs. Weatherization and membership and fundraising obviously are internal items of the nonprofit, but still, notice membership and fundraising, they're direct, considered direct functions. The total direct cost up here is the grand total of all these four columns, and that's the way they want you to do it. There are significant numbers here. The first is this 1.111 million. I changed the color here. Hold on a second. That part I can do. Okay? And that becomes a labor base. Labor and fringe is this number, which is also important. And the modified total direct cost number is down here. Notice the pool, the numerator, is here. So HHS says you can develop an indirect rate on any three methods you would like to do. And you can put them either direct and have any one of these three allocation bases. So if you follow me over to the bottom left side, they say you can have just a direct labor base. You can have a labor and fringe base, which is the same as up here, number 2, right here. Or you can have number 3 down here, a modified total direct cost base. You can barely see it. It's down at the bottom there. And so there are the three bases. They all have the same numerator. Same numerator. Same numerator. It's the denominator, big or small. And so the small denominator results in a larger rate. The large denominator, it's 17.6, I believe, results in a smaller rate. And that's the challenges of what you're doing in developing an indirect rate. And all three of them, depending upon your approach and your thinking, is the way that this is supposed to be put together. So I hope that this makes sense to you. This is the approach that this group, which we're going to call Helping Hands, used in developing their indirect rate. So let's move on to the next one. See how that works. Okay. This is a real organization. I chose it because it's simplistic. And this bracket here going to the left, this is the 2010 Statement of Function Expense, almost identically just like the way that it said program here, administration here, which is their indirect, fundraising, where if we developed a rate, fundraising then becomes a part. It's included in the cost of program, and administrative is the numerator over which there's fundraising and program. Now, if you look at the bottom, they had overhead allocation. That 125 was actually allocated. The 125 here was allocated to fundraising and to program on a GAAP basis. When we developed the program, we reversed this 125 and we added basically back to the 99, and so it's like 225 or 226 or something. And that's how we started with this process. So on an OMB basis, you can move this back. But it's nice to see this is a very, very simplistic statement of functional expense. And then often what we'll see is that they'll give you the full detail for 2010 and one column of 2009 just to do a comparative year analysis. This is the starting document that we've got to reconcile. And if our numbers disagree with those numbers, then we've got to explain why. The main thing that we've got to reconcile to is this number here, 2.4 million or 2,400,609. In the following documents, you try to put that in the back of your head, we will reconcile to 2,400,609. And so that's the number, and that's very important to the government and so forth. Someone asked the question that I'm saying that I'm showing that fundraising is as program expenses. No, fundraising is definitely different than program expenses. What I'm doing here is I'm trying to set up a basis. Fundraising, I'm going to add that to program to develop my indirect rate. If this was all I had for this organization, I would add these two green circles, the totals together, as the denominator. Okay, I don't have a thing, but let's just make it even. This is $225,000 for it. So I'd have this pencil, as you can see, doesn't do very well. And that 225 will be divided by 337. Let's just say that's it's going to be different. It's going to be, let's just say the base, because it's 2.4, is 2 million, okay, 2.1 something million, 175 million, okay? So what I'm trying to say here is I'm going to take this administrative cost. This is going to be my numerator, and I'm going to divide it by the sum of program costs and fundraising costs once I've added these two together. That is the 125 and the 99, and I'm going to come up with a rate if I were going to do this on a very simplistic example. In other words, A122 says fundraising must be treated like the functional area of fundraising must be treated and included in the allocation base, the denominator, for which admin costs will be the numerator. So that's what I'm doing. I'm now just developing an indirect rate. I'm not making them one and the same. I hope that clarifies a little. Okay, this is a real helping hands. It's a real entity. You notice on the left side, let's see what I'll use for colors here. I'll use blue or purple. This follows a statement of functional expense in that here is your labor, here is your benefits, and here's the other costs. It's actually an 8.5 by 14, and we have to click on the second page just to get to the very bottom. But you get the sense of what it is. We have set up the grand totals here, and probably if we go to the second page, there it is. The grand total is 2.4,609,000. I'm going to try a little bit and make it just a little bit bigger for you, because I can realize that it's kind of small to see. So you can see here that these are the total of all the expenses. The next column is the exclusions. They were all the things that were unallowable. And then we start with total adjusted cost. And they had a lot of programs, lots of programs. And so that's how we started to deal with it. Now, I'm going to go back because what I want to do is I want to show you this thing in total, although it's very small. Let's go back up to the top. So the purple areas, let's see if we can get this back to, no, we can't. No, forget it. The purple areas here were all the direct costs. If you notice down here, rent, watch this little line here, rent. Rent and all the other costs, the purple area represents areas where they could take rent and other supporting costs such as utilities, long distance telephone and office and computers, and they could charge it direct. So in this example, what we try to do is organize all the awards where they could actually charge these costs direct. And actually the grand total, it's kind of hard to see, it's over here. Let's see if we can, no, we can't. Yeah, we can. And you can almost see it here. The grand total for all the direct costs here is $56,000 for rent, and here's some of the others. And what we were trying to do was, this organization never had a NICRO. It never had an indirect rate. And so what we were trying to do was organize and find out, well, first of all, what awards are they permitted to have the recovery of direct rent? Let's just keep it at rent. And then what awards were they not? And that's why we have purple at the top for awards they could. We get to orange, and some of the orange costs were allowable. Some of the utilities, looks like in this range here, some of this stuff was allowed to be recovered on certain awards. And the green, ultimately, none of the direct costs could be, as you can see over here, the grand totals for the green, none of them right in this area. None of them could be recovered direct. And we were trying to organize this thing so we could try to do a bifurcated G&A. In the end result, HHS said, no, we don't want that. We just want a simplistic rate. And so we decided to choose a salaries and fringe base, that is direct labor with applied fringe. We decided to use that as the allocation base. So again, if you look up here at the very top, these are the grand totals. And the total labor was $1.1 million. Their applied fringe was $243,000, which got a grand total of $1.3 million as their allocation base for both salaries and applied fringe. We did not use the modified total direct cost base because there was some rent that was direct and some rent that was indirect, and we didn't want G&A to hit the modified total direct cost base that had direct rent. So we felt that was one way to approach this. HHS accepted it. Let me see if I can get to the grand total. Let me go back. This is a reconciliation. This shows you, here's the direct labor, here's the applied fringe on direct labor, here's the total, 1.3 million. Then you have the other direct costs. You have the G&A of 214,299. You had some unallowables, and then the grand total. So let's go back, and I will show you how the rate was computed. Because this pages go down here, and we'll make it a little bit smaller so it'll work. Here we go. So what we have down here, and these numbers are small, these are the individual components. These are the G&A salaries, the fringe on G&A salaries, and the non-labor G&A to get to 214,299. So this is the numerator, okay? The denominator is made up of direct labor, and it's made up of applied fringe on direct labor, and that's 1.353 million. So the rate is really 214,000 divided by 1.3 million, and that gave us a rate of 15.84%. So our rate was that we got approved with HHS was basically 15.84, where we used an allocation base of direct wages and applied fringe. We did not use a modified total direct cost base because rent was sometimes direct and on awards, and we didn't want the G&A that had some direct purpose rent and G&A. Excuse me. Lost my voice there for a second. So we didn't want the rent that was in G&A, that we had both indirect and direct purpose rent and G&A to hit the other direct cost rent that was approved under this purple area. So what we did was we just said, let's just do it on a direct labor plus applied fringe base. All right. So that will generate a few questions. Let's go back and get this a little bit bigger. This is the actual text document. You could call it the cost policy statement. And the cost policy statement is very, very basic for HHS. All they want to know is, tell us a little bit about your organization, and then tell us about your cost allocation methodology, what fiscal year you're using. Notice, whatever fiscal year, they want it to reconcile to the statement of functional expense. So there's no way of getting away from a statement of functional expense. When the government asks you this several times, and they ask you for this, you got to provide it. I mean, there's just no way around it. So be careful that what they ask you for, you provide. As far as direct cost and indirect cost definitions, a lot of people just simply use whatever are the standard definitions that are actually in the document itself. And that's what they use. Okay, let's go to the next page. Down here at the bottom, they want an explanation, and you can certainly pull this document up afterwards. I'm sure Health HIV will have this on their website. And you can look at how we define what the pool and the base included, and our explanation and a rationale for why we felt we needed to use a direct salary and wage plus fringe benefit base. And so we wanted to make sure that where rent, direct purpose rent, was sometimes charged direct on a grant, we didn't want there to be any double charging. And so the way we got around it was not to have a modified total direct cost base, but a base that is basically direct salary and wages and fringe benefit base. So you can read that and see where we came up with that position. The next thing that they want you to do in their written text document is they want you to reconcile the total cost, which remember I talked about in the beginning, the $2.4,609,000, with the total in your proposal. So they want this to reconcile to your audited statement of functional expense. We just give some additional information here, and we said here basically that there was an internal allocation under note 1 here. We said that there was an internal allocation of overhead from administration distributed to direct functions, and that was removed in order to determine the entire amount of G&A. In other words, if there was a credit, we were able to get the total amount. Salaries, it can be a pretty difficult situation to do, because what they want to know is everything that was charged in that G&A rate, they totals to $56,400. So if you remember when we went back to that big spreadsheet, at the very bottom, the total labor dollars that was in G&A, the G&A labor, was $56,400. They want you to tell them what is the amount of dollars that was allocated by person. You don't have to put in their name. And so we made sure that was gone. They didn't have to do that. Just position and function. And then they want as what percent of total salary. So you can see that most of their cost was not in G&A. They had allocated most of their cost direct to other functions. But you need to do this reconciliation, what I would call a distribution of labor. And a lot of organizations don't have this kind of stuff, but you need to reconcile to that. Ultimately, we come down here and we develop the rate. This kind of works almost perfect. The computation of the base and the pool. Unfortunately, for some reason, in the way that HHS sets it up, they want you to give the details of the base first. So fundraising, program support, advocacy, they did have some HIV care and prevention. These are the program or functional areas. This is the base. This is the pool and the rate that was computed from it, 1584. So once you start to line up, like I said before, once you line up these costs in a meaningful methodology, where I can pull those indirect costs fairly easily, and I know what's in my base, the denominator, here's the denominator, here's the pool, they're reversed obviously, I can develop an indirect rate fairly quickly. The complication with this entity was the fact that they had some occupancy cost. They didn't have an indirect rate initially, and I don't blame them. They tried to get occupancy cost on any federal award they could get it on, but they couldn't get it on all their federal awards and not on all programs. And so they came up with this rate methodology that seemed to fit best for them without getting into double charging. This is an important part, too, of this document. This part of the document is where they want to know, how do you treat supplies? And they said, we identify it as direct or indirect based on whether we assign it as a direct function or indirect function, which has different charge numbers, and we put it on a purchase order. So what they're saying with a lot of their expenses is that you can have supplies direct or indirect, you can have duplicating direct or indirect, long distances tracked direct or indirect by code, postage, all of these things are tracked pretty much direct or indirect based on the purpose, like travel. It's based on the expense report. Did we do travel of an indirect nature, supporting the overall G&A of the organization, or did we do it as a part of a program or a grant? Rent could have been direct or indirect, as we discussed. Depreciation, down at the bottom here, the rules are depreciation always has to be indirect. You cannot have it direct. So that's one of the, and of course consultant agreements, it's direct or indirect based on the work scope. For example, I might have helped them develop the indirect rate, so I would be a part of their G&A. I would have been an administrative or G&A cost. Whereas they might have had a consultant to write a proposal. That would have also been G&A. They may have had another person that actually helped as a consultant on a grant or a program. That would be direct. So that's what they're trying to describe there. It's very straightforward, not that complicated. At the very end, they're going to have a checklist for you. They want to make sure if you've got audited statements, you're using them, that you're reconciling the indirect cost proposal amount. The indirect cost proposal has been made and is included in this proposal. So they want the two to agree with each other. Unallowable expenses in item 3. Unallowable expenses have been eliminated from the numerator or indirect pool, such as interest, charges, penalties, bad debts, donations, employee gifts, etc. And the denominator, they want to make sure you put everything in the denominator, like fundraising. That would sit in the denominator for developing the rate. Also, if you had donated in-kind service, and that amount was material they would want that in the base as it impacts labor, because labor would be larger if you keep track of it, the dollars. If you don't record in-kind volunteer services, then you don't have to worry about it. They also said, and you remember back in item G, they wanted a functional analysis of all the people, anyone that touched the indirect cost pool. They want to know who charged there, because whoever charges G&A labor, that G&A labor then hits a grant for recovery, and they want to know. Paid absences, such as vacation, holiday, and sick, generally those for nonprofits are included in the wages base. They're included in wages. In a rare case, like for government contractors and a few large nonprofits, they may put that in the fringe pool. If you leave it in the base, that's fine. That's what most nonprofits do. You're also saying in item 7, we haven't made any significant changes, or this is our first year, and there's been no change in the treatment of an expense category or something like that. And even in the paid absence one, I think in the original one it says not only is paid absence this, vacation, holiday, and sick, but that it didn't change from last year. So I think in the original sample document that HHS provides, it may have that requirement as well. But in number 7, they want to know, is there any significant changes that impact the rate? 8, they just want to know your capitalization threshold. This organization had a very low capitalization threshold of 500. Under the A122 and under the super circular, your capitalization threshold could be as large as 5,000. Then they want you to kind of sign this checklist, and the last thing they want you to do is sign a certificate saying here that you follow the requirements and standards of the lobbying cost principle under OMB Circular A122. In other words, you don't have any lobbying costs that's included in this indirect rate proposal. If it is, it's a direct charge that's unallowable in the base. It's not in the numerator. And that's the kind of thing they want. Well, after you do all that, then you notice this group, they got their 1584, and the base is direct salaries and wages, including all fringe benefits. That's the base. Often what became the historical thing for 1 year becomes the projected or provisional rate for out years. So ultimately, this is what you're looking for. And of course, we know with Ryan White, there's still a restriction on 10% administration costs, which could be direct or indirect, doesn't matter, but it's still limited to 10%. So you have to look at this and say, do I have, in a strategic way, do I have or can I go after other awards that fit within the mission of my entity, for which they don't have these very extreme Ryan White restrictions of 10% admin costs, or they may have some other limitation. And you can do that by going to CFDA, that's Catalog of Federal Domestic Assistance, CFDA.gov, and you can look at the programs from a 20,000-foot thing, and they would say in there like administrative costs are restricted or not. Then you can begin to develop a little bit of a strategy and say, you know, I've gotten some awards now. They don't have these restrictions, and this is another way to recover indirect costs, which then helps me towards the main goal of sustainability, which you know Health HIV has been teaching a lot about lately, not only here but in our regional conferences, sustainability, sustainability, sustainability. And if you can recover your indirect rate, it's going to help you with your sustainability because it's something the government offers. But there are restrictions on Ryan White, but not on other programs. So, Julio, I think that pretty much ends my presentation. If you want to turn it over for questions.
Paul, I have a question that came in, and I will just go ahead and read it to you, if that's okay.
Okay, that's fine.
It says, why would any entity go with the MTCV denominator? I can't see how that would benefit an agency. If all G and PX are allowed in the numerator, regardless of the denominator, then I would always want the denominator lower so I could have a higher IDC rate.
Well, this is my response to you. You're going to get the same numerator as you saw. We could flip back a few slides and see that. You're always going to, the numerator, the government's always going to give you your numerator, but the denominator will change. Here we go. See in this example, The pool is the same in all three, but they had different denominators, which meant different rates. You're going to get no more than the numerator. If you have a smaller denominator, it's just the numerator is allocated over a smaller amount of pieces, which makes you have to have a higher rate to compensate and reverse for a larger denominator. Really, you're going to get your costs pretty much no matter what you do, regardless of what allocation base you use. It's just certain bases make more sense in certain situations. That's the best way I can explain it. It's a good question.
I have another question, Paul. If you include fundraising and lobbying expenses and program expenses in the denominator, you'll have a lower indirect rate. Would it be okay to do that?
You have to do that. You don't even have a choice. So yes, in other words, including in your allocation base, which is your denominator, the rules in A122 and even in the new super circular say, any major type of expense that's not recoverable, like a functional area of membership, fundraising, public relations, lobbying, advocacy, policy, all that good stuff, that has to be in the denominator in the allocation base. So if you have a modified total direct cost base, it'll all be in there. If you have a labor base, then it's just the labor portion, but it must go into base by rules, and yes, it will result in a lower rate. The government's saying that they should, those areas, according to the government in their great wisdom, they should receive a share of your indirect cost.
Okay, I'm scrolling through. I know that Paul had addressed some of the questions that folks had throughout. If anyone else has another question, you can feel free to type it in the chat box or in the Q&A box. Okay, I have one more for you, Paul.
Okay.
When you allocate rent in the occupancy line, would it consider you're charging rent to direct cost? So what is the difference between rent and occupancy?
I'm sorry. You know, a lot of times we refer to the different words. Occupancy is basically rent too. You're right. The only real difference is that it may also include utility. Occupancy may include utilities, other maintenance, repair costs. You know, things like that. You know, even insurance could be in there if you wanted to. What I'm trying to, so when I say occupancy, I'm saying it has rent, but maybe a few more items besides just rent in there. Hopefully that answers your question.
Great, thank you.
Okay.
Does anyone else have anything that they would like to cover in terms of questions or points of clarification? All right. Give it another couple of seconds just in case somebody is typing furiously. Folks, just to let you all know that because several folks have asked these questions, we will post the webinar. Oh, we do have one more question, but I'll address that in 1 second. Post the webinar. The webinar has been recorded, and the materials, the presentations, and the handouts that you have been viewing will be posted to the Fiscal Health section of the Health HIV website. The links to the recordings will also be housed there as well. And this question, it just says, what about mortgage interest allowable?
Okay, that's a good question, and I'll be quick about it. Mortgage interest is allowable, but there are a lot of restrictions that go with it. The mortgage interest is included in the interest cost principle in A122 if you're a nonprofit. And so there's so many exceptions to it, like, for example, there'll be a reduction of your interest that's allowable if you don't own at least 25% of the building. So if you kind of did it where you're leveraging everything and you have a very small down payment and that kind of thing, they're going to limit the amount of interest That's allowable as an example. Also, depending upon whether 40% or more is related to federal activities. If you don't have a certain percentage that relates to federal activities, you won't get it. So the bottom line is currently they call that an advanced understanding or agreement. So with your awarding agency, if you're going to enter into something like this, you need to read that cost principle very clearly and sit down with them and get an agreement. The agreement probably would be with the Division of Cost Allocation. They're the ones, because they're going to be dealing with these indirect rates, and I would urge you to, once you've gone through it all, sit down with them and get a negotiation. But yes, a portion or all of it, depending upon that interest, mortgage interest principal, could be allowable. That's correct.
Okay. We have a couple more minutes if anyone else has any other questions. All right. In terms of wrap up, once we close out, there will be a brief, there's one more. If you allocate occupancy to direct program and your modified base in calculating the indirect rate, would that still be okay?
Probably not.
The second part is, I'm sorry, or okay. do you need to use the direct S and W base?
It would be better to use the direct SW and applied fringe base or direct labor base, because basically what happens is, and if some of the direct purpose rent cannot be recovered direct and it sits in G&A, then if you have an MTDC base, there's direct rent that's there, and the two might be double charging. So apparently, with HHS, if you use the direct salaries and applied fringe or just a direct labor base, they probably would accept it. I hope that helps you.
Great. Thank you, Paul.
Sure.
So for anyone that has any additional questions, or I know that folks have joined later, the entire, as I stated, will be posted on the fiscal health section of our website. If you have any questions in the interim that you'd like to pass on to either myself or to Paul, you can, I see one more just came through.
That's good.
Does utilities include electricity, water, and telecommunications as well?
Yes, you can make it as large as you feel appropriate. Utilities could be whatever. You could maybe even make the argument for under occupancy, or even utilities, but probably not utilities, but under occupancy in general, you could say the part of your infrastructure is even the website. So if you think about, maintaining that infrastructure, that's quite a bit. So, I mean, it's more up to you to define what is utilities for you. What is all the different things that it includes? It's going to differ from organization to organization. Then if you're going to wrap that up into what your total definition of occupancy is, more than just rent, utilities, maybe includes infrastructure of your organization, such as something even like telephones or a website, just the raw infrastructure of it. You could consider doing it. I've seen people do a lot of different things. It's you defining it and then following it consistently and in accordance with the regs.
I have two more quick questions, and then I think we will go ahead and wrap up.
Okay.
One really quickly was, is it likely that there would be a site visit to verify info in the application?
No. It'll all be over the phone. Desk review. Good question.
And then the follow-up, there's a follow-up question to a previous question that says, what section of the super circular describes restrictions regarding previous question, charging occupancy to direct program and using modified base?
Well, it's not going to be a section. It's going to be more of the principles of consistency. And it's a good question, because what you want is you're asking your mind, and I don't blame you, what about all these other permutations? The regulations are written a little bit general in some ways so that they can address all situations. So what they're going to say for you is, remember in this thing in the text document, there was like describe how depreciation is allocated direct or indirect and so forth. They want you to describe how you're going to allocate your costs, and your costs may be different than others, and is there any, double charging? Did you take any direct purpose stuff that's both indirect or the same purpose and charge it direct and indirect? And that's what they're going to look for. You should look for that first. And then everybody's system is going to be a little bit different. So what I'm telling you, and I know this doesn't help you to some degree, they give you the guidelines, the standards, the best practices, and then it's your job to see whether it works or not. In most cases, the modified total direct cost base is a good base. But when you're emerging and you've charged some of your occupancy costs direct, you may have to use an alternative base so you don't have double charging or do something in a transition period. And that's where we'd have to discuss more specifically later. I hope that helps.
Okay, great. Thank you. So thank you everyone for participating this afternoon. I've gotten a number of emails and messages from folks again asking about last week's webinar. That is housed on the fiscal health section of healthhiv.org. We are currently in the process of writing a grant today, but we will be posting either today, tomorrow, or as soon as possible the link to the recording of this webinar, and we'll also post the slide decks and the worksheets that Paul has been showing us today on that portion of our website as well. If anyone has any questions that they would like to pass on, my email address is julio, my first name, Julio, Julio, at healthhiv.org. We will keep folks that have signed up appraised of any additional webinars that will be coming out with relevant fiscal health topics, and look forward to providing any information or materials that you're interested in to support you. Thank you again for your time, and thank you, Paul.
You're welcome.